Methodical. You might assume accounting software does the heavy lifting to organize your finances. It doesn't. Software is simply a tool. Putting unverified, messy data into it will only give you unreliable financial statements. To get numbers you can actually trust, you need to follow the exact workflow professionals use. We are going to walk through the 5 distinct steps CPAs take to turn raw transactions into a perfectly balanced trial balance. Before you start, gather your prerequisites. You will need your accounting software, all of your bank and credit card statements, and your past financial records. Treating accounting as a strict, logical sequence is the only reliable method to build financial reports you can use to run your business. Step 1 starts in the past. Always review prior periods, like last year's tax returns or financial statements, to establish a historical baseline and identify recurring patterns. Next, identify every source of transactions for the current month. Gathering data from checking accounts, credit cards, and processors like Stripe or PayPal, funneling everything into your ledger. If you miss even one source, your books will be permanently incomplete. They will never balance. Finding all your data up front prevents structural errors from corrupting the rest of the accounting cycle. Step 2 is categorization. Every transaction is assigned to one of 5 categories: assets, liabilities, equity, revenue, and expenses. Vendor mapping software rules automate this. For example, the system can automatically route Home Depot charges straight to your maintenance expense account. Be careful to avoid a common beginner error here. Never record personal owner draws as business operating expenses. Keep personal and business activities strictly separate. Consistent, rules-based categorization turns a meaningless list of bank charges into clear business intelligence. Step 3 is your security checkpoint: bank reconciliation. This is the mandatory process of mathematically proving that your company's internal software records match your external bank statements perfectly. To do this, place records side by side. Verify transactions by checking them off one by one until your software's cleared balance exactly matches the bank statement's ending balance. This process catches hidden fraud, exposes duplicate entries, and ensures you aren't missing bank fees. Here is a strict rule. An income statement is worthless if the cash accounts on the balance sheet have not been reconciled first. Step 4 covers required adjustments. Not all business activity triggers a direct bank transaction, so you have to make manual entries before closing the books. Standard examples include recording asset depreciation from a fixed asset schedule or adding accrued interest on a business loan. You also need to avoid the net payroll trap. Do not just log the cash that hit the bank. Use the gross-up method, which zeroes out a clearing account while correctly recording your total salary and tax expenses. Software automation handles the easy cash movements, but mastering these manual adjustments separates amateur bookkeeping from CPA-level compliance. Step 5 is your mathematical quality control test, the trial balance. This unadjusted trial balance for Paul's Guitar Shop tests the accuracy of the double-entry bookkeeping system. Look at the very bottom row. You can see that the total debits of $186,300 perfectly match the total credits of $186,300. But remember, a balanced trial balance only proves that your math is correct. If you accidentally put a $500 expense in the wrong category, the report will still balance, but your financial classification will be wrong. Achieving this matching trial balance is your final quality control gate. Once the math is proven, you are permitted to generate your official financial statements. By following this sequence, you now have clean data, reconciled cash accounts, and mathematically verified books. Because you respected the professional workflow, you can confidently click Generate Reports. This is a finalized example corporation income statement. The revenues and expenses listed here are reliable, specifically because of the tedious categorization and reconciliation work you completed in steps 2 and 3. Now that your data is verified, it is time to analyze your profitability. Subscribe and watch our next video to learn how to read and interpret your newly generated income statement and balance sheet.